In a week marked by significant turbulence across precious metals markets, silver trading became the center of intense scrutiny following a series of dramatic developments involving the CME Group, open interest data, physical vault withdrawals, and major institutional positioning. What unfolded on Wednesday has drawn attention from veteran traders, market analysts, and participants across both Eastern and Western financial markets, raising serious questions about the structure and integrity of paper-based commodities trading. At the heart of the story is a sharp and sudden decline in CME March silver open interest. In a single trading session, open interest dropped from approximately 11,882 contracts to just 10,526, a reduction of 11,356 contracts, representing more than a 50% decline in one day. In practical terms, this meant that potential delivery obligations fell from over 110 million ounces of silver down to approximately 52.6 million ounces. The scale and speed of that reduction is being cited as highly unusual by market observers. Shortly after that open interest data was recorded, a trading halt was initiated across metals markets. During that pause in trading, 31,828 contracts changed hands, while retail traders were reported to be completely locked out of the market. When trading resumed, silver prices had already moved approximately $4 lower. Subsequent waves of selling then drove the price down further, ultimately moving silver from approximately $91 per ounce down to roughly $85, a total decline of approximately $6 from peak to trough. These price movements, combined with the circumstances surrounding the trading halt, have prompted commentary from notable figures in the trading community, including veteran trader Peter Brandt, who publicly discussed the possibility of legal action against the CME. Against this backdrop, physical silver markets and Eastern exchanges have continued to tell a markedly different story from what paper price movements alone might suggest. Turning now to the detailed market data, the technical picture in silver following Wednesday's session showed price declining to the $85 level before staging a recovery. Market observers noted that the 150-period exponential moving average on the hourly chart served as a confluence level at that price point. Price subsequently recovered from that level, moving back up toward the $88 range, where it was reported at the time of this broadcast. Additionally, a pattern described in technical analysis as a swing failure pattern was observed on the charts. This occurred when price moved below a significant prior low established at 9 a.m. on Tuesday, before reversing and closing substantially higher. That pattern had previously been identified by the reporting source at the $72 price level, at a time when broader market sentiment was described as deeply negative. On the physical side of the market, COMEX vault data released following Wednesday's session documented significant inventory movements. According to that data, approximately 1.3 million ounces of silver were withdrawn from COMEX vaults during the period in question. The breakdown by institution was reported as follows: 218,000 ounces adjusted out of Brink's registered inventory, 624,000 ounces withdrawn from HSBC, 25,000 ounces from JP Morgan, and 619,000 ounces from MTB. Total registered silver on COMEX now stands at 86.13 million ounces, with total COMEX inventory reported at 360.64 million ounces. The coverage ratio, calculated as registered silver divided by open interest, currently sits at 0.60, meaning that registered silver covers only 60% of 1 month's worth of open interest. Expressed differently, for every 10 contracts outstanding, there is physical backing for approximately 1.4 of them. Furthermore, 54.51 million ounces of silver have reportedly left COMEX vaults over the course of the past 30 days, representing a 13% decline in total inventory within a single month. These figures are drawn directly from documented COMEX vault records as cited in the original reporting. It is also documented in the reporting that a prior comparable intervention by the CME occurred on November 28th of the previous year. Following that event, silver prices rose approximately 120% over the subsequent 60 days. That figure is presented strictly as a historical data point based on recorded price history. Turning now to developments in Asia and their implications for global precious metals markets. Significant regulatory and institutional changes have been reported out of India that are drawing attention from market participants worldwide. India's securities regulator has granted permission for actively managed equity funds, representing approximately $385 billion in capital, to allocate up to 35% of their holdings into precious metal instruments, including gold and silver. This represents a substantial potential flow of institutional capital into hard assets. Beyond that allocation permission, a second and arguably more consequential development was also reported. Beginning April 1st, India's regulator has directed mutual funds to value their physical gold and silver holdings using domestic stock exchange spot prices, rather than prices set by the London Bullion Market Association, commonly known as the LBMA. According to the information reported, this move is designed to eliminate the complexity associated with currency conversion, transportation costs, customs duties, taxes, and other adjustments that have historically been tied to Western price-setting mechanisms. In effect, India is decoupling its precious metals valuations from the LBMA benchmark entirely. This development is being described as a significant architectural shift in how global precious metals pricing may function going forward, particularly as it relates to the relationship between Eastern and Western financial markets. The Shanghai silver market, meanwhile, has continued to show a persistent price premium relative to Western spot prices. At the time of reporting, Shanghai spot silver was quoted at approximately $97, with Shanghai futures at $100, while Western spot prices sat near $88. That represents a premium of approximately $9 that has continued to persist through the trading halt, the price decline, and the open interest reduction described earlier. Adding another dimension to this broader market story, the reporting references a lawsuit involving Jane Street and the now collapsed Terraform ecosystem. Court documents cited in the reporting describe a private group chat established between a former Terraform intern working at Jane Street and Terraform personnel, through which material non-public information was allegedly exchanged. Specifically, on May 7, 2022, at 5:44 in the evening Eastern Time, Terraform reportedly withdrew $150 million from a liquidity pool without public announcement. Within 10 minutes, a wallet connected to Jane Street allegedly withdrew $85 million from the same pool, the largest single transaction in that pool's recorded history. The combined withdrawal totaled $235 million. 6 days later, approximately $40 billion in market value had been erased. Jane Street represents one of two institutional defendants referenced in this reporting, with Jump Trading having previously faced a separate $4 billion lawsuit from Terraform's administrator in December. The connection drawn in the original reporting between these crypto market events and the current silver market situation centers on what is described as a shared structural dynamic: concentrated institutional positioning, information asymmetry, coordinated activity during periods of stress, and retail participants absorbing losses while institutional entities record profits. As we bring together the full scope of this week's reporting, several documented figures and verified data points stand out as central to understanding the events that have unfolded. To recap the key facts on record, CME March silver open interest fell by 11,356 contracts in a single session, landing at 10,526 contracts, a reduction of more than 50%. Potential delivery obligations dropped from over 110 million ounces to approximately 52.6 million ounces. During the subsequent trading halt, 31,828 contracts changed hands, while retail participants were reported to be locked out. Silver prices moved from approximately $91 per ounce down to roughly $85, before recovering to approximately $88 at the time of reporting. On the institutional positioning front, Jane Street was reported to hold approximately 20.6 million shares of SLV as of the fourth quarter, making them the largest holder of that instrument with a position valued at approximately $1.3 billion. In India, the regulatory decision to open $385 billion in actively managed equity fund capital to precious metal allocations, combined with the April 1st directive to shift silver and gold valuations away from LBMA benchmarks and toward domestic exchange prices, represents a formally documented policy change with direct implications for how precious metals are priced and valued across one of the world's largest financial markets. The Shanghai premium of approximately $9 over Western spot prices has continued to persist throughout this period, according to the data reported. Veteran trader Peter Brandt has publicly raised the subject of potential legal action against the CME in connection with Wednesday's events. The Terraform-related litigation continues to move through the courts, with a Manhattan federal judge now presiding over questions related to whether certain market-making activity in crypto markets crossed legal boundaries. That concludes our coverage of this week's developments across silver markets, COMEX vault data, institutional positioning, and related regulatory changes in India. All figures and events referenced in this report are drawn directly from documented on-record sources as presented in the original reporting. We will continue to monitor these developments and bring you further updates as additional verified information becomes available. For now, this has been your financial news broadcast. We thank you for watching.